Welcome back to the Dividend Diplomats YouTube channel. You know you're rolling with Bert and Lanny, the Dividend Diplomats guy. We are filming this here on August 23rd, a Tuesday night. And guys, we're talking about three dog dividend stocks right now that have just been beat up, stone cold stunned, pedigreed, rock bottom right through the mat.
Fun fact about these three stocks that are just dogs in our portfolio, we own every single one of them. So this will be fun to talk about the stocks. Everyone, before we get into these three stocks, smash the heck out of that subscribe button. Give this video a nice thumbs up. We are pumped up to talk to you about these three dogs in what is one fascinating stock market.
Guys, hold on to your seat here, but we wanted to bring three dividend stocks that have really dragged against the market this year. And I mean, talk about three stocks that are really never at these stock prices. And we just wanted to present the case to the community here, maybe get Bert's feedback, my feedback on all three stocks, kind of like what we're doing with all three. I mean, the yield on one's almost 6%. One is almost 4%, and one is now well over 3.5%.
Yeah, and I think it's going to be important to talk about them and understand why we're not necessarily panicked about these companies and why looking at the metrics, looking at the numbers, and seeing what that story tells is going to be as critical as ever. Because if you read the headlines and you hear what's being talked about these companies, you would just run for the hills. But the numbers may tell a different story on why, as buy and hold investors that have a long-term mindset, that are investing for 10, 20, 30 years down the road, things may be slightly different.
Yeah, exactly, guys. So we're talking about three stocks. We're going to focus on the metrics, the Dividend Diplomat stock screener. We're talking the price to earnings ratio, the dividend payout ratio, and third, that dividend growth rate and growth streak. And obviously, we already mentioned it. We're going to dive into that dividend yield because you're a passive income investor. You want to build that income stream. So then the dividend yield being a component of that.
That's right, Lanny. So before we get into there, I think it'll be fun. We're going to talk about how these companies are performing year to date. So let's keep one thing in mind. The S&P 500 year to date is down about 14% at this time per Google Finance. So keep that in the back of your mind as we talk about these three stocks. We're going to benchmark each one of them against the broader market.
All right, who's ready to look at some beat up dogs here, guys? We're going to dive into that first dividend stock here. We're going to run through the metrics because we got three of them. The first stock is, yes, we're going to stay in Ohio. We're going to talk about this dividend stock yet again. Scott's Miracle-Gro. Ticker symbol is SMG. And man, Bert, down 55% this year.
Yeah, they're performing like the manure they sell at that company right now. It's been a long, yeah, it's been a long fall from Scott's Miracle-Gro. And Lenny, correct me if I'm wrong. Was their 52-week high? Are they long out of that? It was well over $200 per share at its peak before it came tumbling down.
It was in a whole other universe right now.
Yeah, just hasn't been great. Sales are plummeting. They made some bets on the marijuana sector that just haven't necessarily been panning out for the company, and the stock price is getting punished for it.
Getting punished, down 55% this year alone, 53% over the last 52 weeks. Again, adjusted, consensus earnings estimates right now is $4.31. Stock is trading at under $75 per share. It's almost like the story of Bert Stanley Black & Decker here. It has hit below a threshold I don't think we would see. So it's below 75 at 74.32. But Bert, what's that first dividend metric, that price to earnings ratio on SMG?
You had to drag Stanley Black & Decker into this, didn't you?
That's right.
They're not one of the other two companies on this list, everybody. So keep that out of here. That first metric for Scott's Miracle-Gro. Price, $74.32. EPS, $4.31. That PE ratio is 17.24.
So that earnings estimate has really come down. But the price to earnings is still below the S&P 500. So there still could be some value, but let's dive into that second metric. Is this dividend safe? Remember, we like to see below 60%. So paying right now a nice quarterly dividend of 66 cents per share per quarter, or $2.64 on the year. A dividend payout ratio right now, based on 2022 annual earnings estimates, is actually over 60%.
By a smidge. So let's look at the other metrics. That 5-year dividend growth rate, 4.90%. They've increased that dividend for 12 consecutive years. But here is the most interesting thing about Scott's Miracle-Gro. Every year, they typically announce that dividend increase at the end of July or beginning of August. We are still waiting for Scott's Miracle-Gro annual dividend increase right now. They have not announced anything so far in 2022.
No dividend increase, no bump up yet. Now, as long as they bump it up, I believe they have some time in next year. The way that their dividend was always staggered, because again, they have 2 quarters of the increase in the year. So technically, this dividend is higher than last year's dividend. Now, the big kicker is going to be they have then 4 quarters. They essentially have the first 9 months of next year to increase. So between this day and the end of September, they pretty much have to announce a dividend increase.
So looking at that bonus metric, the dividend yield, 3.55% currently. So more than double the S&P 500 at its current level.
Man, so to summarize, a 17 PE, 61% payout ratio, 12 years of increase in their dividend at about 5%, not including the special dividends, with the yield that is now over 3.5% on this dividend stock.
Let's move into dog number 2 of our portfolios. That company, it's in the wireless communication sector. I bet you all think we're going to be talking about AT&T, don't you? Well, if you thought that, you were wrong, because we are talking about Verizon, ticker symbol VZ. Big Red has lived up to its name when talking about how the stock has performed year to date.
Yeah, again, year to date down well over 17%. And guys, I didn't think we would see below $44 a share, but it has happened. It actually hit a brand new 52-week low today at $43, and it finished at $43.47 for Verizon wireless stock.
It's fascinating how fast the story on Verizon has turned. You have Verizon, who is always the cream of the crop in the wireless sector. They are just getting lapped by T-Mobile right now. So T-Mobile continues to just eat away at Verizon and AT&T and just deliver strong results, which is causing this stock price to tumble. The great words about Verizon and how strong of a stock they are, they're starting to see some cracks in that foundation.
So guys, right now, consensus estimates right now are $5.18. So that price to earnings ratio, that first metric, is still insanely low at 8.39. But keep it in mind, could this be a value trap right here?
Second metric, that payout ratio, their annual dividend is $2.56. Divide that by the 518. That is a perfect dividend payout ratio of 49.42%.
Oh yeah, brother. You know what I'm talking about here. That dividend growth rate, 17 straight years of growing dividends at an average rate of 2%.
All right. And how long have they increased that dividend? You said for
17 years.
All right. So they're close to becoming an aristocrat. They still got some time. Surely that dividend yield has to be nice for Verizon in that wireless communication sector. You know what, Lanny? It sure is. That dividend yield is currently 5.89% at these levels.
Guys, 5.89%, almost 3 times every high yield online savings account with good old Verizon. Obviously, with the lower dividend growth rate, you need a higher dividend yield. And that is exactly what you're getting with Verizon. But again, AT&T, being a dividend aristocrat, had no problem reducing its dividend after the spinoff of Time Warner Media. Verizon, though the dividend is very safe at barely 50%, could there be a reduction in the future? That's something that we'll cover that here in a second.
All right, so let's summarize their metrics. PE ratio 8.39, payout ratio 49%, 5-year dividend growth rate 2.08%. Increase that dividend for 17 years with a yield of 5.89%. Time to move into lucky number 3, Lanny.
All right, the trifecta on the dividend dogs right now. And wow, this stock is down 24% this year and 40%, down 40% in the last 52 weeks. We're talking about none other than the Top Gun living, the Paramount swinging Paramount, ticker symbol PARA.
Yeah, we're waiting for this pop to come up with Paramount, but the streaming companies are just getting demolished right now. You're seeing it across the sector. This isn't just a Paramount thing, too. This is Comcast is getting beaten down. Netflix is going through their issues. I mean, the sector is dealing with slowing subscriber growth and the increased
Netflix
cost.
is down 60% plus this year.
So Paramount beating Netflix.
Yeah,
But
Disney's also down 27% this year.
yeah, I mean, it's getting more expensive to generate content. It's getting more competitive, which means you have to spend more to keep growing that base year over year. So it's an interesting thing what is happening in the sector.
Yeah, I would say it's very interesting, guys. Again, which is why it's on this list, being down over 24% and down almost 40% in the last 52 weeks. But let's dive into the metrics. Consensus earnings estimates for Paramount, even though they just are crushing stuff. And I think Top Gun is being released right now on Redbox. So not only, if you missed it while it was in theaters, feel free to stop at your local Redbox outside of your Walgreens grocery store to really support all entities there. But let's dive into that first metric, that first dividend diplomat metric, that price to earnings ratio, $2.33 is the earnings estimate. $24.50 was the closing stock price here on August 23rd. P ratio at 10.5, Bert.
Let's look at that payout ratio, annual dividend, 96 cents, divide that by 233. Another perfect payout ratio on the very low end of the spectrum of 41%.
And usually it's lower, but I think obviously the estimates of earnings has dramatically decreased since the last video.
Moving into that third metric here, 5-year dividend growth rate is 6.67%, but that's slightly misleading here because they have not increased their dividend since Q4 2019 or Q1 2020. That was the last time they announced an increase there when they increased it to its current level. So it's remained stagnant, but at the beginning of that 5 years, the dividend growth was phenomenal for Viacom CBS at that time.
Yeah, again, that was under Viacom CBS, that last increase from 18 cents to 24 cents. So guys, it's been a few years. The question is do we get a dividend increase this year at the end of the year?
We'll see. Let's look at that yield, that bonus metric, 3.92%. So you're getting a nice premium, not Verizon levels, but it's beating out Scott's Miracle-Gro.
So in summary, for Paramount, ticker symbol PARA, 10.5 price to earnings ratio, 41% dividend payout ratio, technically a 5-year dividend growth rate of 6.67%, at a yield of almost 4% at 3.92. Bert, let me hear your take, your feedback. You own all 3 stocks. Let's hear.
I do. I mean, what's interesting to me is this is when you hear about 3 dogs and 3 stocks that aren't performing, you really, in my mind, you really want to focus on that dividend payout ratio just to see, is the dividend safe? Is there a climbing payout ratio that's getting closer to 100% that might be indicative of a future dividend cut? Right now, I feel pretty comfortable with each one of the 3. Obviously, you can't predict what's going to happen and what management's going to do. The highest on the list is 61% with Scott's Miracle-Gro. Verizon and Paramount, I think they're just kind of stuck. You might not see strong dividend growth, but I don't feel bad about those dividends.
Okay.
What about you?
To buy, I've been buying Scott's Miracle-Gro a lot this year. I might buy one share at under 75 because it's probably $5 less. I probably bought it a little bit under 78 or 79 a few months, maybe a month or so ago. Just because I feel like there's kind of with the housing economy and obviously with recessionary, I feel like okay, people probably aren't spending as much right now. Plus, they are probably dealing with a lot of cost increases right now, and I feel like that's just going to be a short bump in what could be a long road.
Yeah, no, I think it's a good point with Scotch. It's one I haven't picked up, but it's one I should definitely be considering right now. I mean, if I'm going to look at any of these, I mean, in my mind, I actually don't know. Maybe Verizon at that 52-week low, it's kind of the same reason you had. Add in 5-10 shares, maybe just lower the cost basis in my position, not go all in, but bring that cost basis down. This might be a good opportunity to do so.
The only thing I'm worried about with Verizon, I feel like this is like the same story with AT&T. Like, oh, it's dropping, yield is popping. Do we?
Yeah, yes, they definitely have some debt, but I think they don't have. What's going to be different is they don't have this like cost suck that was Warner. Like, you didn't realize how much the costs were increasing in the spun off division that was causing even more pressure on AT&T's overall earnings and balance sheet.
Yeah,
and they
I
didn't have
agree.
DirecTV. Let's not forget about DirecTV here. If Verizon acquires DirecTV, I'm gone.
And then you have Paramount, which they're doing well from a box office, from a results standpoint, from a subscriber standpoint. Everything is growing. I feel they're kind of just getting taken down with the rest of the industry.
I'll tell you what, if we have any of them that get caught up in a short squeeze and get stuck in your bed bath situation, I'm gone for the hills. I'm running for the hills on any one of these three if you get that opportunity. But hold on a second. But in all seriousness, that's what's interesting about these numbers. I agree. Paramount, they still got the content. That's what's going to drive all of this. That's why these places are so valuable. It's the content in the streaming wars that's going to win. And that's what separates Paramount from some of its competitors.
And obviously, guys, not professional advice here. Definitely do your own research. Now, Bert, if Verizon drops below 43, are you buying a share?
Sure.
If Paramount drops below 24 or 23, are you buying one share?
Maybe. But they're so
if Scott's drops below $73.
Yeah, maybe. I don't know. I feel like Scott's at 70, Verizon's close to where I'm going to buy it, and Paramount probably 23.
All right.
What about you? What about you?
Yeah, I think if Verizon cracks 43, I'm buying a share. If Scott's Miracle-Gro cracks 73, I'll buy a share. If Paramount cracks 23, I'll buy a share. I think it'll just be a nice 130, $140 just to kick it in a little bit.
And just remember, before we sign off here from there, remember, we're not talking large dollar amounts here. When we're talking about this, we're talking a couple shares nibbling here and there. We're not throwing in thousands of dollars into this right now. Just keep that in mind as you're going through this and as you're making your own decision, that these are not the big splashes that we've made with other purchases.
Yeah, not swinging for the fences here, but what are you guys doing with these three stocks? Do you guys already own these? Have you been buying them this year? Have you been buying them this week as the stock price has been coming down? Do you believe in the future of all three companies to grow earnings again, to have dividend growth that's strong? Let us know in the comments your feedback on these dividend stocks as you're building your passive income cash flow.
And if you own a holographic Charizard, let us know in that comment section below which one it is. That has nothing to do with this video, but just put it down there because we love it, and that'll be one of our favorite comments.
And maybe you'll sell it to Bert, guys. Now, if you haven't already, definitely subscribe to our channel. Like this video. We appreciate it as we spread the dividend investing news out to the community. Bert, any other parting words on your end?
No, just keep digging, keep finding these undervalued stocks to buy and grow your passive income.
There it is. That was Bert the Hurt and Laney from the Dividend Diplomats. Over and out.